Hey there, welcome to another episode of PhysicianEstate podcast. This is your host, Dr. Harsha Muley. I am the owner and operator of PhysicianEstate platform. I am podcasting to you today from Kansas City, Missouri. PhysicianEstate is a physician-owned real estate platform directed towards doctors in USA. We provide free real estate resources and investment opportunities to physicians. We facilitate physicians make wealth and keep wealth. You are currently listening to podcast 5 of PhysicianEstate podcast. In this episode, you will learn about the profits in real estate investing for physicians. Real estate syndication deals have a sponsor who creates the project and investors who invest in the project. Sponsors are looking for investors to invest in their projects. The primary goal of a sponsor is to have the investors invest into their project and that the project makes profits. The primary goal of the investors is to gain above average returns on their investment in a risk-mitigated manner. Few investors that are new to investing in these projects, due to the lack of adequate insight and background knowledge, are at a risk of falling prey to sponsors with bad intent. Our goal is to equip the amateur investor with the ability to analyze the real estate projects and the sponsors of the project. How do you understand the profits in real estate syndication? There are so many ways in which sponsors try to grab attention of the investors, luring them with higher returns, higher numbers. For a new investor, it can get very confusing when they hear the terms return on investment or ROI, cash on cash return, COC, internal rate of return, IRR. I will not go into the details of explaining all the metrics mentioned above. I have read the definitions of these terms multiple times and tried to apply them to the syndication underwriting documents that I review on an ongoing basis. Even until today, I often get lost on how these terms could be interpreted for a particular deal. Due to the complexity of how these metrics can be interpreted based on the specifics of every deal, I rather tend to stick to some basic principles of understanding. I try to keep it simple and ask myself, if I invest in a particular project, what am I making? If I invest $100 into a real estate syndication deal, what am I making? And more importantly, how soon am I making it? Wealth generation is not a function of quantity of money you're making on a particular deal, but it is also a function of time. How soon are you making that money is an important question that you have to ask. Rather than giving you a theoretical explanation of how the numbers work, I think it will be helpful to go over the topic using a couple of example scenarios. Scenario 1. Now, let's walk through a traditional payout model of a real estate syndication deal. I invest $100 in a deal. I start getting paid $12 every year starting from the day of investment. And in year 5, the property is sold at an appreciated price, and I will be paid a total of $125 for my shares in the property when the property gets sold. Overall, on my $100 investment, my initial capital was returned to me in year 5, and in addition to that, I made a total of $85 profits in 5 years. This $85 comes from $12 per year for 5 years, along with a $25 profit at the end of the sale. My take-home points on this deal are I made $17 per year. Although I made $17 profit per year, I did not have access to my initial investment until the end of the deal at year 5. I would consider this as a solid return on investment. However, I wish I received my initial investment capital returned to me sooner, so I could have used this to invest into another deal. Let's talk about another scenario, scenario 2. Let's now assume you're investing into a slightly more risky syndication deal that involved a significant value add or renovation component to it. I invested $100 into it. Since there is a lot of construction involved, the property does not make any profits in year 1. I am estimated to make $12 per year on year 2 and year 3 as an interest or as distributions. Property will be refinanced in year 3, so the bank will cut us a big check when this happens. I will receive a check for $100 on year 3 at refinancing period, but I still get to keep my equity in the property. I continue to make $3 a year from year 4 until year 10, and the property will be sold at year 10. I will receive another $110 at year 10 from the sales proceeds. Overall, on my initial investment of $100, my initial capital was returned to me at year 3, In addition to that, I made a total $155 profit in 10 years. And I made this $155 by making $12 per year for 2 years and $3 per year for 7 years. My take-home points on this deal are, I made $15.5 per year. Although I made a few dollars less per year compared to my prior deal, my initial investment capital was returned to me at year 3. This is 2 years sooner than the prior project. I would consider this deal a much better deal compared to the prior deal because my initial investment capital will be returned to me sooner than the prior deal, so I can reinvest this capital into another deal and compound my profits. Also, since my initial capital is returned to me sooner, my capital is exposed to project-related risks for a much lesser time. However, you must have an appetite for risk tolerance when you decide to invest in value-add syndication deals. 2 important topics that most amateur investors don't often realize is first, the effect of compounding to grow your wealth. I would want my initial investment capital returned to me sooner than later so I can put that money back to work and generate more money. Point 2, the amount of time your money is exposed to the risk of investment. Any investment has an inherent risk to it. I would want my money pulled out of an investment as soon as possible to minimize the amount of exposure to the risk. Now let's talk about standard profits in today's real estate syndication market. Based on what I see in today's market and deals, most of the syndications are offering a $15 per year profits on every $100 you invest. Of course, there is a wide range to it based on the time frame of return on investment, the percentage of equity held, and the overall structure of the deal. Trick is to understand when your initial capital is returned to you for obvious reasons mentioned above. My objective in this section was to simplify the returns and numbers so an amateur investor can understand them. If you are hoping to learn the definitions of ROI, COC, IRR, I am truly sorry to disappoint you. There are many legitimate financial websites like Investopedia, etc., where you can find detailed explanations and videos of these definitions. Please help yourself by visiting those websites to get more information on these topics. Thank you for listening to another episode of our podcast. In the next episode, you will be learning about the real estate syndication process for physicians. To receive more information on real estate syndication resources for physicians and to get updates on real estate investment opportunities with PhysicianEstate, please subscribe to our newsletter at www.PhysicianEstate.com. Do not forget to take advantage of our 2 new eBooks, ABCs of Real Estate Syndication for Physicians and How to Avoid Medical Malpractice Lawsuits. Signing off for now, this is your host Dr. Harsha Muley. Until next time, make wealth and keep wealth. Disclaimer: I am not a legal advisor or investment advisor. The content in this podcast is not investment advice. This is my personal blog and all the content found here is for informational, entertainment, or educational purposes only. It should not be construed as personal investment advice.